Best ever listeners, welcome back to another episode of the Actively Passive Investing Show. If you're tuning in on audio, I apologize. I'm shooting this on my phone because I'm on a walk and I haven't done one of these episodes in a while like this, but sometimes I get these little epiphanies or ideas that I want to share with you guys, and sometimes by the time I get back home, I've forgotten half of what I wanted to say, so I go ahead and I record them out here. With that said, there was something on my mind. I was in a recent deal as a limited partner. That deal just sold, and the IRR return, the internal rate of return, was quite high. It was high to the point where you might say, you know, that's a fantastic return. That was an awesome syndicator, blah, blah, blah. But I got to thinking, how was that? Sorry, there's a little moped in the background. I got to thinking, how was that return actually achieved? So how much credit should I give to the operator versus just what happened in the market? And so what we're talking about is, in my opinion, one of the things that is often missed and not spoken about when it comes to these syndications and these return on investments and these IRRs. It's quite easy to say, you know, we bought a property at $60 million. We sold it for $80 million. So therefore we made $20 million, right? And that sounds fantastic, but what was the situation? Was it that you operationally improved the property by increasing the net operating income, and that the fair market valuation increased substantially, and therefore you really did a value add business plan and created a lot of value for your investors? Or did you just find a good deal at a good price and then you happen to get an above the market offer, therefore not giving so much credit to the operator? So to that point, I was in another deal, different deal now, I'm talking about years ago, and they projected about a 20% IRR return. We ended up getting about a 10% annualized return. And so here's my simple way of looking at that. This operator more or less bought a good property at a good price in a good market at a good time, but they did not execute the business plan the way that they intended to, the way that they told investors they would. In other words, they said, we're going to buy this, the rents are whatever, $1,000 a month, we're going to move them to $1,300 a month over 5 years, blah, blah, blah. They really didn't. They got a little ways into the value add. They ended up selling the property early and exiting out of it, and they really didn't do a lot. But here's the point. They bought a good asset at a good price in a good market at a good time. The market was going up. Why? Because interest rates were coming down. Cap rates were compressing. It was a growing market. So we ended up making, in my opinion, a 10% return just simply because the market increased. In other words, if interest rates were flat, cap rates were flat, and the market was flat and no one really moved in or out, and the operator didn't do anything to the property, then nothing would really change the value of that property. So we would have a 0% return if they didn't do anything. But the market bailed us out. And this has been happening, of course, for almost 10 years, if you think about it, right? The market's been up since 2012, more or less, is kind of when the bulk of the recovery started happening in real estate. Now here we find ourselves in 2022, about 10 years down the road. And again, we've had reduced cap rates, reduced interest rates, and so in a lot of people needing to rent and own, and we're behind in housing. And so market conditions have made a lot of people a lot of money. As they say, a rising tide lifts all ships. What you got to look at, though, I talk a lot about looking at track record of an operator. You can't just say, what IRR have you given your investors? And they say, well, 18% historically. Well, that's awesome, but how did they arrive at the 18%? So here's the metric nobody talks about. What was the net operating income that they actually changed on the property? So in other words, let me frame that a different way. That might have been kind of confusing. So what I would look at is, we'll use, well, no, I'm not going to use any specific examples just for, sake of privacy. Okay, so an operator says we have effectively increased the net operating income by 30% on our properties historically. That's the metric you got to look at, because they actually went into the property and they either cut expenses and or they increase the rents. That effectively changes the net operating income on the property. And I've spoke about this a lot, but just to recap quickly, the net operating income is the primary driver to the value of what someone's willing to pay for a multifamily property or self-storage or mobile home parks or whatever. So simple way of looking at it. Hey, you've got a property that produces $1 million per year, let's say, for example. What am I willing to pay you for that $1 million per year in cash flow? Let's say I give you a 20x multiple. In other words, I'll pay you $20 million for that property that produces $1 million per year. So what does that give me as a return on investment? It gives me about a 5% annualized return if you run the numbers. If you take 1 million on your calculator and divide by 20 million purchase price, that's a 5% annualized return. That's realistic, you guys, in today's world. As crazy as that sounds, we're seeing cap rates at 4 and 5%, sometimes 3%. So that's how, especially institutional investors, are valuing multifamily apartments. So when you come in and say you bought that property, $1 million net cash flow, $20 million purchase price. If you can come in and cut expenses, and then you can raise the rents over a series of years by actually adding value to your residents and to the property, and let's say that $1 million is now $1.5 million, and you use that same example of valuation, the equity multiple, someone says, hey, I'll pay you 20x whatever your cash flow is. Well, if it's 1.5 million, you just increase the value of that property by $10 million, right? They're willing to pay you 30 million for that same property because it now produces $1.5 million per year, not 1 million per year. So that's the metric that you should always be asking for. You should always be looking at, because think about it. You can apply this to single family homes. If you had bought a single family home, almost throwing a dart out there in the US, any city, in 2018, and you were selling it today, you probably made money. But that doesn't mean that you're a smart investor. That doesn't mean that you did anything to the property. That means that the market went up. And so you can't rely on markets bailing you out forever. You can't rely on working with a syndication firm that relies on markets bailing them out, because I've seen it a lot, and it's great to put together your little track record and say, you know, again, we've given investors a 18% return, but what did they actually do to produce it? So something to keep in mind. I hope you guys found some value out of this episode. I hope the audio held up for us, and we'll see you next time on another episode of the Actively Passive Investing Show. Have a best ever week, everyone.